All right, guys. So this video is going to be an introduction to the ABC strategy. Now, a lot of people recently have been asking me, hey, what's your strategy? How do you get these entries? What's your mindset? How do you approach this? I basically different variations of the same question. And I realized that I really don't have a direct public intro of the ABC strategy. So I figured I tell you guys what it's about, where I learned it from, and kind of give you guys an idea of how it works, why it works so well, and how you guys could implement it into your own trading strategy. So first thing first, I want to introduce the concept of how I evolved into this. So when I first started trading was back in 2020, and pretty much all I did back then was, take kind of the same direction a lot of you guys have possibly taken. I can't speak for everyone. There's basically two routes where I know people have, or two directions people have taken overall. Is one is the indicator side where someone shows them this strategy or show this indicator that basically tells them, hey, this is going to give you an edge in the market, all this crap, blah 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 blah. That's going to be a topic for another video, but pretty much, long story short, a lot of those people who follow that route don't end up making it because they find out sooner or later that the indicator is not the answer to their problems. And you also, that leads into the next section where some people do start here, some people get to this point after that, but it's approaching trading as just using patterns, using support and resistance, which is where I came from. I pretty much took the same direction as most of you guys did. It might vary a little bit, but I took the approach of I found an indicator that was better than everything else in the market, so it was going to give you an edge. And pretty much, long story short, if you guys haven't found that out, you guys will find out soon that isn't the answer. The answer isn't the indicators that are going to give you an edge, because you come to find out that a lot of these indicators lag. And most of the time, I can come up with the exact same answers as most of you will have. If not, I'll be in the right direction versus you being in the wrong direction before your indicator even prints the idea of taking a short or taking a long. I'll probably be in that position before you anyway. And it sounds kind of cocky, but the truth behind it is that these indicators lag, so you're not going to get the right answer until it's too late. And the problem with that is that you will take bad positions based on what the indicator tells you. You'll notice that sometimes you'll take a position when you get a sell signal or a buy signal, and next thing you know, it's pretty much going against you pretty fast. That does happen a lot, but especially a lot more with that style or that version of trading. So from there, I learned how to take a step back and kind of learn the basis of support and resistance and patterns. I'm not going to sit here and draw that for you guys. You guys can go find that information on YouTube. It's actually pretty easy to find, and it's not the best, but it's not the worst. So that's the next step I took, and eventually I got introduced to an idea called Elliot wave theory, or a strategy called Elliot wave theory. And this is where we're gonna lean or go into the ABC stuff. So originally, ABC stuff is a version of Elliot wave theory. Now, if you don't know what Elliot wave theory is I'm gonna summarize it because I'm gonna miss stuff. I'm gonna not give you the full scoop of what Elliot wave theory is, because that in itself is a lot to talk about, and it's not my thing. So I'm not gonna sit here and throw all this information at you. Pretty much, long story short, is that Elliot wave theory calls for a strategy that learns how to read trends, and you basically use the rules, the ideas and principles of Elliot wave theory to determine what the next possible move is. Now, obviously, that's pretty much trading in general. You're trying to figure out the next move, but it approaches it in a different way. So in Elliot wave theory, there is a thing called impulse waves and correction waves. And the basic principle behind each is impulsive waves are aggressive trends in one direction. So for example, you can consider this an impulse wave here. This is an impulse wave. This is an impulse wave. Something that's a very aggressive in movement relative to how big the previous move was and how sharp this could be. And then corrections are opposing trends following the previous trend. So technically, this would be a correction. Oh, that's wrong. This would be a correction. I'll just change the color of that. That did not work. I'll do like red. But apparently, you know, this is a correction. So that's like the basic idea. And the way these are shaped is they count trends within the impulse wave. So this is going to be, let's say, a 1, a 2, a 3, a 4, and a 5. Okay. And Elliott wave theory says that impulse waves moves in structures of 5, and then correction waves move in structures of 3s. So ABCs. And something like this: A, B, C. All right, so that would technically follow Elliott wave theory. The problem with Elliott wave theory is that there's so many different variations of the waves here and how to count them that in real time it's almost, I would argue, almost impractical to find a logical reason and an actual decent plan to take a trade off of, because there's so many different variations. And that stems into the problem of trading in general, is that this stuff can be complicated, but it doesn't have to be. Trading is, the easiest way to explain it, almost like a puzzle. Now, I'm not going to go too deep into this, but easiest way to describe it is, if I gave you a picture, right? We're going to do 2 puzzles, right? Each puzzle has the same picture on it, right? If one puzzle was, let's say, 50 pieces, and let's say the other puzzle is 500 pieces, and I told you, okay, which one could you figure out easier? I would hope all of you would say the 50-piece puzzle. At the end of the day, trading, all of us that are trading are trying to achieve the same goal, is to understand what the next possible move is in the market and make money off of it. But the problem is, with Elliott wave theory, with indicators, with a lot of these strategies that claim to have an edge, you run into the problem of these things being so complicated that you can't figure out the answer to your problem, or the answer to your question. So with Elliott wave theory, it might seem easy, you know, just me kind of just drawing, but there's so many variations, so many rules, so many different things you have to look out for, that it becomes almost, I wouldn't say impossible, it becomes extremely difficult to maneuver the market properly. So this is where the ABC method comes in. So if you guys are interested in this, I found a downloadable version of this. You know what? I'm not gonna look for it now. I forgot the name of the book, to be honest. I'm gonna find it here in a second. It's a case for modification. Case for modification. Wait for it to pop up. Of R.N. Elliott wave theory. Okay, here it is. So this is where the book, this is the book that the idea stems from. Okay, so it's called Harmonic Elliott Wave: The Case for Modification of R.N. Elliott's Impulse Wave Structure. Okay, I don't know where the other version of it I have, but I don't expect you guys to spend $150 on this book. So I'm going to say that if you can find a version of it online, I would suggest really taking the time to read this, because this book is not easy. It took me a very long time, and I've had to read a lot of sections more than once. And I took the information off that book and I implemented it to in a way that is user friendly, if that makes sense. To where, because the problem with is, even this book has its own problems. The problem, so one of the things I have an issue with this book is that it talks about fib retracements. Now, if you guys don't know what fib retracements are, basically is you can use a retracement tool to calculate certain percentages of a move prior to the previous one. So I know that might be a lot, but let me just say this. If you draw a fib from the top to the bottom of this uptrend, because this uptrend is continuous, all right? So this is going to be the bottom, and this is going to be the top. You can see that there's certain numbers on here, all right? These are percentages of that move. So let's just put over here for, you know, easy reference sake. So this number right here, let me actually shrink this. I apologize. I'm trying to get this onto, trying to make this make sense. So I hope you guys have a little, at least a decent, I hope it's not too hard. But this 5 right here is 50%. So 7,064 is 50% of this entire move. Okay. And there's different fib levels you can use, but with Elliot wave theory and also the ABC method, it calls for, Elliot wave theory method calls for certain percentages to be hit. Okay. The problem is when you have such strict rules like that, the market doesn't follow rules exactly. So a lot of the times you'll try to follow these rules, but you notice that price will break through these certain levels, and next you know, that's more of a curveball. That's another piece of the puzzle you can't figure out. So that's just a brief explanation of how traditional Elliott wave theory uses fibs. Now in the book, basically it's saying that whatever the previous trend of the trend that you're drawing ends up lining up, you're supposed to do math. So basically the easiest way to explain this is the book calls for, right? The book calls for the first trend, which is A, all right? And then you're going to do plus because it wants you to take the percentage of the next trend's retracement. So in the retracement, it's going to be the B wave, right? So A plus B, and I'm sure you heard this before. Oh, I fucked up. I'm sure you heard this before. A plus B equals C. All right. So what the ABC method calls for, oh my God, I'm so sorry, I'm fucking this up, is saying that, let's say this is A, all right? This is A, and let's say this is B. A, B. And now what the book is calling for is saying that wherever you pull this back to, I am royally fucking this up. I apologize, folks. So I'm going to do my best to try to figure this out and not make this too complicated. So then I got to do math. I think that's right. So basically what this is saying is, all right, so I'm going to do, this is going to be, like I said, this might be complicated, but there's a reason why this is the reason why I do my best to keep it simple. So in the ABC method, the correct way to use this, it's saying that if the B wave in this case retraces to about 85% of the total trend of this, your target for that should be the 185% of the previous two trends. Okay, so your target for this, all right, so if you bought, let's say you're able to get a spot buy here. Your target to sell would be about 50,000. Now we all know the answer. That actually, would you look at that? That actually came pretty spot on, close to what the book calls for. As much as in this case example, it did work really well. The problem is you're adding another piece of the puzzle that can make this more complicated. Now, granted, it's a lot easier to maneuver than traditional Elliott wave theory because all you have to do is just math. But the problem is that sometimes you can overreach and you can overuse this too much to where you're discrediting certain positions, discrediting taking profit at certain areas. So what I did, and what a friend of mine and a good mentor of mine, Kite Crypto, have done, is that we've taken this method and we simplified it. Now, how do we simplify it? The best way to explain it is, instead of looking for A plus B equals C, we're using the trends itself to identify possible structure and trend changes. What I mean by that is, I'm gonna give you two examples, right? And I'm gonna go down to the chart and show you guys real-time examples, positions I have taken, and showed you how accurate this can be. So basically, you're gonna hear me say, whether you watch me through, mostly you're gonna hear me talk about this on YouTube. So we're doing the live streams. If I say there's an ABC here, is because I'm looking for, on an uptrend, a retracement, and a continuation. All right. In this case scenario, I'm going to be shorting every time price, once the C wave gets past the A wave, I'm shorting once price gets back below the A wave. All right. Sometimes it's not perfect. Sometimes it is. You know, in situations like what's going on now, which I'll give you a real-time example of, you're going to have moments to where it bounces and plays with this region before it makes a decision. So the reason why it's simpler is because now we took out the other components of what the ABC method is, and now we're only left with one thing. All right, is one rule, is if you have original uptrend with a retracement with a continuation, as long as price remains below the original uptrend, the top of the original uptrend, it's safe to assume that there is a good chance that the price can reverse from here. It's not guaranteed, but you got to understand is that trading, you want to look for statements, particularly if this then that statements. So for me, the if this then that statement is, as long as price is below this area, I have the right to assume that this is a possible place of reversal. Not guaranteed, not the top, but a possible for a top. And like I said, I'll show you the examples how this is accurate, but let me show you guys a downtrend reversal example. So in this case, let's say we're in a bear market, or let's say that we're in a downtrend, okay? You have an original downtrend here. You're going to have a retracement to where price pumps, and then you're going to look for a continuation. All right? And the new if this and that statement for this version is, as long as price comes back above the origin of the A, you have the right to assume that this is a possible bottom. Not the bottom, a possible bottom. So you would be taking a long based off of that level that the A ends at. All right? So hopefully that's the easiest way to explain it. Let me show you guys a couple examples of positions I have taken using this method, and let me show you something that's real time and the reason why I'm coming up with the idea of me going short from certain areas. All right, so this one right here, now that I show you that, here's a perfect example of a massive ABC. A, because this is all continuous, one trend, a pullback, and a continuation, right? If price on a macro scale remains below 65,000, this is, you have the right to assume that this is a possible top, not the top, a possible top. In this case, pretty damn close. All right. And without diving too deep, ABCs on a bigger scale have ABCs within them. So for example, this was an A to a B to a C. This downtrend was an A to a B to a C. This bigger bear market is just a bigger A, B, C. I can sit here and do this all day, but I want you guys to, if you guys are going to really dive deep into this, I want you to watch the other tutorial videos that I have available on my Discord. And unfortunately, it's a paid private Discord. So you guys get access to a bunch of information. You get access to me. You get access to real-time positions of me showing you how I use it real time. So I don't want to give you all everything at once because it's a lot to consume. But hopefully after this, if you guys are interested in learning it further, you know, I hope you at least come to me. If not, my buddy also who taught me does this as well. I will give you guys some information if you guys really want to. I'll probably link his channel in the description below too, if I remember. So, okay, example. So I showed you that bigger one. Okay. Now let's just go zoom in just a tiny bit. Maybe it's like a 4 hour. Look at this one. On a bigger scale, A, B, C. Now it's not exact, but this is a possible downtrend reversal. As long as price is below or above this line, you have a right to assume that this is a I keep saying right to assume. This is the easiest way to how I explain it, but this is your invalidation statement. As long as price is above this, you should be long, or you should be at least not bullish, but you should be longing this or buying this. You can structure your positions accordingly. So let's say you want to get a spot buy. You're not going to be, you're only going to be buying. Remember, you're only going to be buying once price gets below and back up, not on the test. Only when it gets back below this point and then back up. Let me just draw that with an arrow here. Okay. So if price gets below where the arrow is at this point here, and it comes back above, then you should be longing. All right, if you give yourself on say a macro position, you gave yourself a decent stop loss. All right, you could have taken profit anywhere. But still, on a macro swing, a 12 is massive. So that's just one example. Let's see if I find another one here. All right, here's another one. This one's a little, let's see, this is an example of it being very choppy. But same thing. A, do a B, and now a C. Your if this and that statement, your invalidation point is at this 42,000 area. Okay. And as long as price is above, you should be longing. You know, I remember this time clear as day. It was not a good time. You got stopped out a good amount of times. But if you stuck to it, you know, since it's a little bit of a smaller time frame, I'm not going to be using as loose of a stop loss. I like to be a little bit more aggressive in my positions personally. You had a 25. I tell you what, you wouldn't have gotten stopped out 25 times, maybe like 10. So you walked away. Let's say you got stopped out 10 times, net positive 15. All right. Here's an example of one on a bigger scale that was almost perfect. Right here. A, B, C. Now, you have your uptrend. The uptrend breaks. Once that uptrend breaks, you have a point of invalidation. Now, in this case, you have to wait for price to break through it. But once price is below this region, you should be shorting. According to the method, you should be shorting. And you, like I said, this is not perfect, but I shorted this almost exactly. And I got stopped out, I think, like 4 or 5 times. And I pretty much held it. I held it to about... here. This was probably my biggest short I've ever had. Profit-wise, no. But R&R wise. We just highlight this area for you guys. I took profit around here because it was dancing in this area. So that's an ABC. You have a right to short it as long as it's below there. And it might have taken you a couple tries, but you would have gotten it. Okay. I'll show you guys maybe one or two more just to give the point across. These are, like I said, these are real-time examples. These are trades that I have taken personally. Same thing here. This is all one continuous trend. Once you break, all right, you have to wait for price to come back above here. And I was not shorting any of this. You could have played a little bit in between, but you don't want to go into too small of a time frame. Once price gets above the origin of the top of the A, you should be shorting every time price gets back below. I was using a 1%. I got stopped out maybe, I want to say like 6 times. And I ended up taking profits around here, if I'm correct. I don't remember exactly. Somewhere around here. And then I'll show you one more. And you could have shorted it again. Watch this. A little bit of a smaller time frame. Let's zoom in and I'll show you the details. So, same thing. You have an uptrend. Once your uptrend breaks, this is your origin of your A. So B and C. As long as price is below this A level, you should be shorting. Now, I've only got stopped out maybe twice on this. Like, this strategy isn't perfect, guys. It's just it's showing you that it's not perfect. You're gonna get stopped out. I'm not gonna say a lot, but at least a couple times. So I'm okay with losing. And I shorted just to this wick here because I wasn't sure. I thought this was gonna be a possible bottom, but unfortunately I didn't catch that. So still an 18. If I got stopped out 4 times, a 14. So that's just a quick example of what ABCs are. Why they, so let's go over what they are. Let's go over why they work so well. It's gonna be the last thing, and I'm gonna wrap it up because this is a introduction. There's a lot to go over. I don't want to bombard you with information. It's gonna be the last thing. So the reasons why this works so well is because, going back to what I said before, is that a style of trading that a lot of people use are breakout trades, and that's how I started. That's how a lot of people started, and that's how I made a good amount of money doing it. There's only a certain time and a certain place that you should be going. You should be doing that style of trading. So the idea with breakout trading is it's almost the opposite of ABCs. So instead of ABC, all right, you short on the way back down. You short way back down once you get back below the A. You're actually taking a long if price breaks through. So you're taking a long and you're looking to take profit the next resistance. It depends on where that is. But that's just a basic introduction of what breakout trading is. So I'm going to change this line to green. I'm going to show you a couple places where you would be breakout trading. I'll give you some good examples, some not so good examples. I don't want to draw too many lines. I'll delete these and come back. So in some case scenarios like this one, this trade, breakout trade, was a good one. You probably take profit around this resistance here. This is me trying to go back to my old roots and playing local highs and local lows. All right. So price comes back down. You take a trade, fails, rejects. All right. So now that one's out. So now you have this line. So if price breaks up, you're going to take a long. Broke up, failed, you would have got stopped down and lost money. Now your new statement is here. You would have taken it. Like I said, I'm not sure where you would have taken profit, but let's say you held, eventually would have got stopped out. Now your new breakout trade is here. This, good job, would have been a good trade. This would have been a good trade. This would have been a good trade. As I zoom in and try to take out like more, you can see how some of these end up not being good positions. That would have been a good trade because of how long you held it for. Breakout, you would have failed. Try the next high, would have failed. Next high. So you could see, like, I'm not trying to sit here and paint you a million examples of this, but in some instances it does work. Most of the time it doesn't, because the problem is the market makers and the people who actually have money in this game understand that most people are trading a particular style. This is why I think indicators suck. This is why I think indicators are terrible, because the whales, the people who actually have money in this game, know what is going on, knows what people like you and me are doing. So all they have to do is find a strategy as simple as this, and they use that to trade against us. And so someone who doesn't understand, who's someone who's looking from the outside in, you would think, oh, I keep getting stopped out on my longs. I keep getting stopped out on my longs. But what they're not telling you is that they're trying to take breakouts every single high. That's not how you can see. Most of the time it fails you. So that's the reason why it works so well, because it makes people think that markets are bullish, new high, and it immediately gets rejected. And what happens is, and let's say the next example here, I don't know the exact volume, but I'm sure there was a lot of money that were being put into longs here. But at the same time, whales were selling, or whales were trying to short this. So money's being pumped. Money gets pumped into the market, gets pumped into longs. What happens is eventually people use leverage trade positions like me, like you. People also buy into this. What happens, it gets to the point to where leverage trade positions get liquidated. So if you're leveraging long, you get liquidated. What ends up happening is that the exchange forces you to sell Bitcoin, or the exchange is forced to sell Bitcoin. And so that accelerates the continuation of the opposing direction. And then it gets to a certain point where people who are holding spots, or people holding bigger positions, keep getting liquidated and sell as well. And then this just triggers a snowball effect to where the moves get more aggressive. That's why you have these wicks like this, or these bigger down trends. And it gets to the point to where whales were selling up here while you were trying to buy. Whales were selling their Bitcoin backs because we got a higher high past that 65,000 level. So this triggered a bear market. And so, long story short, that's the reason why ABCs work so well, is because people are using a very basic traditional style of trading. Whales understand, people who have money understand that people are doing this, and they use that same momentum, same strategy to play against you, to help either liquidate their positions or help them sell into you buying, if that makes sense. So I'm sure you guys know this from basic movement of money, but you can get it pretty exact if you know what to look for. So that's just an introduction to ABCs, why they work so well, how I use them to make good trades, how to get pretty good entries. So hopefully that guys helps. And if it doesn't, if you guys are having trouble, feel free to DM me on Discord. Feel free to, if you guys follow me on any other social media and you guys are on here, the best way to contact me is my Discord. I will leave my Discord in the description. Please feel free to ask me any questions regarding this. If you guys want to read the book, feel free to reach out to me as well. I have to dig a little bit to find a link, but I'm pretty sure I can find it. I think I know where it is. I can definitely help you guys, point you guys in the right direction. So if you guys are interested in learning this strategy, feel free to follow me, subscribe to the YouTube channel, or if you're coming from TikTok, follow my TikTok as well. You can see me doing this in real time. If you guys are interested in learning more from me, I do have a paid Discord and it does give you a lot of good information. I do my best to break things down as much as I can to give you exactly how to maneuver this strategy. So if you guys are interested in that, feel free to sign up. I would appreciate it. So hopefully this answers the question of what's the method I use and how I use it. So until I see you guys on the next live stream, or if you guys see you guys on the next TikTok, I will see you guys later.